Okay, so what we're going to do, I'm sitting with a client, but we're going to just walk through explanation of the policy and a lot of the benefits of the policy itself. And so, um, what I've done is I've gone through and grabbed a policy for you, just so we can kind of walk through some things. Any personal information is redacted, and so it's a real policy, but it's for a 41-year-old male for a 30-year term. So you'll see similarities, but yours would be 35 and obviously your age and female. And so the way this is set up, when it issues, it will show you the class of your coverage, right? For you, we're expecting 4, 3, 2, 1. Those are the female classes. It'll be issued on a certain date, and then it'll show us the actual like death benefit amount at that point. Okay. It'll show you your actual current payment at that time, which will be here, the payment date that you get to select and choose, and then monthly bank withdrawal, very, very similar to an allotment. Whoever your beneficiary is will be here. And then if you have a contingent listed, it will be here. The way it's set up as irrevocable is no, meaning yes, it is revocable, meaning you as the policy owner can revoke someone's status as a beneficiary whenever you feel like. We do that in our app or on the myprimerica.com site. Okay, so that's just like a generic overview. Policy specifications will be here. Again, issue date, policy date, class of coverage, what we just saw on the other one, and then what you actually have, right? So this client had a precision 30. For you, we were looking at 35 because you're a little bit younger. And then here's where you will see your breakdown of actual premiums, right? So for the first 30 years and your ages associated there, you'll see exactly what the price is and that they don't change, right? So maximum monthly is whatever you're quoted as and whatever the policy issues as. And that's why we say this is a level term policy for the length of time that we select. Does that make sense?
Yes.
Okay, perfect. And then once you get older, right, this is kind of what we said before. Once you get older, the price is going to go kind of bananas. But if you turn 71 and you are like terminal and you need some, like you're like, hey, I don't care what it costs because my family's going to get 500,000. I'll pay this for a couple months, right? And we'll go over that guaranteed insurability here as well. So whatever length of policy a client selects, their specific ages, their specific monthly payments, okay? And then the premium table, oh, I did the same thing. This is a big one though, guaranteed insurability. Do you have to provide evidence of insurability to exchange your coverage? And the answer is no. And the reason this says exchange is because at the end of a term, you have to exchange it slash convert it into something new with us if you want to continue some form of coverage. Okay. And what you can do, there's options for what you can actually convert to. The most common one, if someone was going to convert at that age, would be decreasing term to 100. And so what that means is your price would stay relatively the same. And then every year you got older, the price stays the same and your coverage decreases a little bit. What that would be, we would have to figure out, 35 years from now, or at the end of whatever the client's, actual policy and term are. The biggest point though is here is you do not require, or we do not require evidence of insurability from you. And the crazy thing about that as well is here's the other piece. When we exchange and convert that policy, if you decide that you still want it, right? The future premium rates are calculated then, but the same premium class shown in the beginning is what you keep. And so this is where if a client comes back with a preferred health rating in their late 30s, early 30s, whatever, now they're 70 something, have all sorts of illnesses and all sorts of problems. Well, when we convert the policy, none of that matters because we're not doing any sort of medical exam. We're not even asking any questions. And if they had a preferred health rating when we convert the policy, they get to keep it. So that piece is pretty cool. So you could be, 74, 75 years old wanting to renew your policy and exchange it for something else. And if you came back with a preferred health rating, but you've got a heck of a lot of stuff bad going on then, doesn't matter. Any questions on that piece?
Going back to the 100 to convert it over to the 100. Can you go back to that part?
Yeah, decreasing term to 100. Mhm.
Okay, and explain what that means again.
So let's just say that you get to so you would be in your mid 70s, right? Let's
Right.
let's say you get to that point and at the end of the 35-year term, you decide that you still want some coverage of some sort, but you don't want to do the one like you don't want this one, right? You don't want to be paying this. And you go, "No, what can you do?" Right? So you say, "Hey, well, you've been paying this for X number of years. Let's convert your policy to decreasing term to 100." What that would do then is at that point, I cannot tell you exactly what it would be, right? There's some future calculation based exactly on you. You
Right.
you would come back with that price and some much lower coverage. Let's just for generic, right? Let's say at 70, that 118 bucks comes back to like 34,000 in coverage. I have no idea, right? But then every year, as you get older, the price would stay the same. The coverage would go down a little bit every year. So we call that decreasing term. Right?
Okay.
And then you might get to a point where, maybe you're 82 or 83, and you're like, well, it doesn't really make any sense to keep paying that for the amount of coverage I'm getting in return. I'm just going to cancel it, right? Go back to the original sort of argument, though, is mid 70s, debts are gone, kids are grown, mortgage is gone. You're also probably retired again at that point, so we're not worried about replacing an income. And if all four of those major factors are gone, we're not really in a position where we would need a whole lot of life insurance anymore because you've got assets to sell, or your heirs would have assets to sell. They have retirement beneficiary accounts that they would be taking over from you at some point, right? So really the need for life insurance is nowhere near what it was when we started the plan. And that's sort of the basis that we're operating on. Does that make sense?
Yep, it does now.
Okay, cool, cool, cool. So let's talk about this one. This is the increasing benefit rider. This is what we were talking about yesterday in terms of like that extra 10%, right? So this will make a heck of a lot more sense when when you see it in the chart form, okay? And so every year you get an automatic increase in the face amount without needing to provide insurability. What that means is this rider is built into every single policy that we issue to a client. You don't have to, there's nothing extra for it. There's nothing because in the first year of the policy, let me get down to the table. Here we go. In the first year of the policy, you pay nothing for it, right? It doesn't cost you anything because you're not getting any benefit for it. That's essentially, month one through month 12. Going into year two, right? So like month 13, if you decided that you wanted to keep it, you would have an extra 50,000 in coverage, and it would be a fraction of what the original policy cost, right? So in this example, let's do it like this. In this example, our client was originally paying 118, I think 34 for his half a million, right? So if we were going to divide that by 10, we would assume that his policy for every 50,000 should cost around 12 bucks. Does that make sense?
Yes.
Okay. Well, here's what actually happens for the increasing benefit rider, right? In the first year, you're getting an extra 50,000. Again, if the client decides they want to keep it, it only costs 8 bucks. Year two, another 50,000, another 8 bucks, and so on and so forth. We get all the way down to year 10, right? The client's got an extra 450,000. Well, now we're going into year 11 through 20. The client's policy has effectively doubled its face value, right? So the original half a million is still there, it doesn't change price ever for the length of the term. But now for years 11 through 20, we have an extra half a million, and the client's 10 years older, could be 10 years like into all sorts of bad health issues, and their second half a million is cheaper than the first half a million, and it doesn't change price for the next 10 years. Now, year 21 comes along, and what most likely we're going to do for the client is delete this. because now your second half a million is going to cost way more than your original policy. I would never
Right.
I would never let a client keep this unless, right? Unless my client calls me right, when he's 60 and he goes, "No, I got some really bad news. I got a bad diagnosis from my doctor." You say, "Well, Mr. Client, I hope we can figure that out. If it gets really bad, we can do the terminal illness benefit and access some of your policy. We'll get to that next. But here's the other nice thing. You can keep that second half a million in coverage for the next 5 years. It'll cost you an extra 600 bucks a month. But do you really care if you think your prognosis is like within the next 6 months, you're going to kick it? Probably not.
Right.
Yeah, because now you're talking about keeping an extra half a million in coverage. And for the next 6 months, what's it going to cost you? 3,600 bucks total? Nobody cares, right? At that point, nobody cares. But if you're healthy as a horse and that comes around and you're like, meh, I'm retired or I'm retiring, I got XYZ taken care of, I got the next half a million for another 10, 15 years, I'm good. Then we'll get rid of it. No questions asked, doesn't cost you anything. Does that make sense?
Yes, it does.
Okay. And so really for the first year, we don't have to make a decision, but really the other way to think about this increasing benefit rider that we build into the policy is that it's sort of like an inflation protection mechanism on your life insurance, right? Think back 10 years ago. Like if you went to buy a house 10 years ago, right? You could get for what a half a million dollar house costs right now, you could get like a freaking McMansion, right? Because I mean, I think 10 years ago, what was that, 2015, right? A half a million dollar house in 2015 when I was a young cat or old captain, like a young major, man,
Hmm.
that was a huge house. Now, half a million dollars down here where we live, I mean, you're barely walking into a 3 bed, 2 bath. It's just a different time, right? And so what this really is sort of like inflation protection. The best example that I have of this is I have a client right now who has a stage 4 cancer, right? I spoke to her husband the other day, and he said, "Hey, this is what's going on. It's not terminal yet. We wanted to check and see what's going on with, we remember we can access some of it, but I said, look, you've got $400,000 in coverage. You've got the second year of the benefit riders coming in, so it's actually going to be 480. You can access 70% of your policy in cash if you need to. We just need the documentation from the doctor once we figure out that she's terminal." He goes, "Oh my God, thank you so much. I was worried they canceled all that because she's super sick now." I said, "No, like it's there forever unless you remove it." Okay, so the increasing benefit rider will always be there. It doesn't matter what health issues the client has going on, like during the duration of the policy itself. And
Okay.
the only way it ever goes away is if a client deletes it, right? So a client calls me and says, "Hey, no, I think I'm good, right? The half million's fine. I don't want it, right? I'd rather save the $8." Cool. You got it, right? So before this kicks in, right, we will go in, it's called a policy change form, remove it, we delete it off, you sign one more DocuSign, it's gone forever. And the problem with that is you can never put it back. That's the only downside, right? You can never put it back. Let's see, IBR, and then
Okay.
last piece, terminal illness, right? So living benefit slash terminal illness benefit. Two different maximums. One is with the waiver of premium, one is without. So if a client does not have waiver of premium, the maximum amount that they can access out of their policy is a quarter million or 40% of the policy, whichever one is less, right? So like if a client has only a $100,000 life insurance policy, they would only be able to access 40,000 early. If they had that 100,000 and had waiver of premium, they'd be able to access 70% upfront. They have to be terminal though, 6 months or less to live. And that's why we call it a living benefit because you're terminal. Now you can actually access a portion of your life insurance before you pass. And you can do whatever you want with the money once we distribute it to you as the client. You can go get experimental medical treatment. You could go on a cruise around the world. You could, I mean, heck, go live at Disney World for a month and a half. It's your money. It's like the old J.G. Wentworth commercial, right? It's your money. You want it now. Do whatever you want. Do whatever you want. When you do eventually pass, your beneficiary would get the remainder of the policy, right? So you, let's say $500,000 policy, you took 350 because that was 70% of your policy with waiver of premium. You went and did whatever you wanted. Your beneficiary would get the 150, right? They just get the remainder of whatever is left over. That's the big, that's some of the big benefits here. One more that I forgot was the actual waiver of premium itself. So let me go find that because it explains the disability portion, right? So policy has a disability waiver of premium. Insured will be considered totally disabled until we pay the final death benefits. You will not be required to pay future premiums. So that's one thing that happens. Like say a client gets into some sort of accident, they become disabled. Now they've been disabled for 6 months. We will refund the last 6 months of their policy and pay the policy for the rest of its life. Let me see if I can find another one on here. Mm, 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 mm. Oh, don't want that. Don't want that. Okay. So I'm going to stop messing around with that because not all of that is redacted. All right. So that's the benefits of the life insurance. I'm going to stop the recording and then we'll kind of jump back into our own.